First Capital is a fully fledged investment bank. Basically, it has 4 business units. One is the primary dealing unit, where we are intermediary into buying and selling bonds. Then we have our corporate finance division, where we raise debt and equity for investors. We also have a asset management unit, which has unit trusts and wealth management options. And also finally we have the equity brokering arm, which supports the equity clients to go into the stock market. So on the strategy report, actually we are looking at basically we are bearish on the fixed income segment. We feel that the tax cuts that have been given by the government may actually weaken the fiscal outlook for the second half of the year, and also will give in a higher borrowing requirement for the government. Also, we have a higher debt portion that we need to actually repay, and with that we feel that there is a possibility, with consumer demand also likely to rise, that interest rates are likely to be bearish and move up towards the second half of the year. So overall bond yields are likely to move up. And then on the banking rates, we feel that the banking rates will be stable for the first half of the year, but start slightly moving up towards the second half of the year. But we feel that the AWPLR will still hover in the range of 9.5% to 10.5%. On the exchange rate, basically we are looking at the exchange rate slightly having a higher depreciation towards the second half of the year, targeting 188 to 190 for the end of the year. And then equity market, we've been very bullish on the equity market, so we're targeting 6,500 for the SPI for June, and 7,500, that is our renewed upgraded target for December 2020. First, most investors need to identify what kind of risk factors actually they are willing to take, because every investment product has some sort of risk. So successful investments are mainly about managing risk and not avoiding risk. So risk versus return is what they need to be mindful of. So they need to have an idea of what type of risk appetite that they can take. So their return will be in line with the risk that they are actually willing to take. So the important factor here is now 2.4 trillion number has been somewhere similar over the last couple of years as well, and possibly in the next year as well, when you add up the less than 1 year treasury bills into the next year's debt. However, the important factor here is over the years now we've been slowly increasing our foreign debt repayment component, and with that what happens is we are exposed to international markets significantly. So now even this year the foreign repayment component, if you take the foreign debt component that we need to pay, is $6 billion. So which is a significant component out of the total debt repayment. So with that we'll be exposed to global interest rate volatility. So basically now towards the second half of the year, during September, we have a sovereign $1 billion sovereign maturity. Now with that we estimate that during the second half of the year, in order to maintain this foreign currency reserves also, we need to raise somewhere in the range of $2 billion to $2.5 billion from the international market. So it can be a sovereign bond, it can be a bilateral loan. right? So when you're looking at that, the global interest rate environment and global investors, how they look at Sri Lanka is a significant plays a significant role there. Yes. So if you really look at it, over the last couple of months, we've actually received rating outlook downgrade. So the outlook has been downgraded from stable to negative by 2 rating agencies over the last couple of months. Now that is mainly due to the hefty tax cuts that the government has received given towards the end of last year and also the start of this year. Now what we need to be mindful of is once the rating outlook downgrade is given, if there is a further deterioration of the economic indicators, they are likely to downgrade, do a rating downgrade itself, right? So with that, what we need to be mindful of is we're looking at raising somewhere in the range of $2 billion to $2.5 billion during the second half of the year. Now with that, if we are going into the international market and if we actually have a rating downgrade, that's a significantly negative impact for international investors because our funding cost is significantly going to rise because of that. So what we need to do is, what the government needs to do is basically, yes, we have given some major tax cuts, that is okay, but they need to put out a long-term plan as to how they are going to bridge the budget deficit if it's going to be expanded, how they are going to bridge the budget deficit this year, and in the future years how they are going to raise additional revenue to cover up the tax cuts, or how they are going to cut costs in the future years in order to bring down the budget deficit. I think if that plan is given, that will give a better outlook towards Sri Lanka for international investors. Yeah. So I think there are a wide range of opportunities. At this moment of time, we are recommending investors to go short on fixed income and go long on equities. So the opportunities are there on the equity side at the moment, but there is a likelihood of a steady rise in interest rates. Once the interest rates have actually come to attractive levels, then there is opportunity in the fixed income area as well. So basically we are actually very positive in fixed income towards the early part of next year. Currently at the moment we are very positive on the equity front. Okay, thank you.